All right. Well, welcome to Married to Real Estate. We are so excited to be talking to you again today.
Hi, Ms. Sayles.
Hello, how are you?
I'm outstanding, thank you.
I
How
know,
are
I'm
you?
excited about today's subject.
So am I. So am
Oh,
I.
it was not that long ago where we didn't really have to think much about mortgages because they were, 3% and everyone was just doing 30-year fix. That was really all we needed to do.
Absolutely, and that's a great lead into what we're going to talk about today. And actually, it does. It brings what we're heading into brings back a lot of memories to me, and of a time.
Memory lane.
Hey, we're turning this into a musical.
Don't get me started.
So, I originally got in mortgage business in 1993, and I would say this, what we're heading into reminds me of that time from 93 to 2003. And rates back then fluctuated anywhere from, say, 5.75% to 8%, somewhere in that. They depend on what's going on with the economy. They'd be up, down, but they kind of stayed in that area. And we're going to come back to that because that's the kind of the time we're heading back into. But we're going to skip the time between like 2003 and 2009 because that was just a nightmare and a fiasco in the mortgage business. We've talked about it before, the things they did that created the Great Recession, right?
Right.
So we'll skip that time period. But as you were just saying, what came out of the Great Recession is this time period really from, say, 2011 to 2022. Whenever anybody thought about getting a mortgage, they would just, hey, I want to buy a house. What's the rate? And let's go, right? Because there was only one product you were going to look at, and that was a 30-year fixed mortgage.
Right. Or shorter. Right.
Or shorter, or a 15-year.
Yeah.
Exactly, right. So, but it was a fixed payment, and we didn't need to look at any options because it didn't make any sense to look at any other options because you were getting a rate. They got as low as 2.75% and maybe 3.75%. They
Right.
fluctuate in that period, and many of us out there have that rate on a 30-year fix, which leads to an inventory problem, which will be a next
Another
podcast
discussion
we can have, right?
Yes.
So, but that time is gone, right? And from 2011, 2022, about a year ago, things started to change, and everything we're hearing on the street, at least the next 3 to 5 years, we're going to have this different interest rate environment.
Right. A varying interest rate environment.
Correct, and it's going to be slightly higher. We may get down as low as 4.75% at the end of this year, but it could go back up to 5.5%, 5.75%. And we're gonna float in a different range.
Okay.
Right? So, what we did back in those 93 through 2003 as loan officers and the real estate agents, and we would do consultations with our buyers, right? And we would actually sit down with them and meet with them, and we would talk about everything, right? So again, it wasn't just, hey, I'm buying a house, 30-year fix, lock me in, let's go, right? You actually sat down and you talked about things, and the first thing was, your payment. What can you afford, all right? So let's go there. And payments are important.
Right. So, I mean, we've often talked to our buyers. We know sometimes it is important to stretch, but on the other hand, we want our clients to have food with their meals. So,
one of our favorite jokes out
Yes.
there, right? And not to stretch out, right? And so you get a payment you're comfortable with, and that's the most important thing. Then everybody can work backwards from there, and then the next thing you think about is a program, right? And so what program can help fit the payment, right? So you don't automatically look at a 30-year fix. You looked at different things, 5-year arms, 7-year arms, different type programs.
and where they were in their life, as far as where they are they, oh, I stole your thunder.
Did.
Oh, I didn't know if you were going there.
Right.
Sorry.
It's right. So we know each other so well. It's part of the married to real estate
Yes.
part, right?
That's a blessing and a curse.
Going, right? So you talk about the payment, you talk about the program, but then you talk about the plan, right? And that's exactly where you're going, because I think I just jogged some memories in your head of talking about that. So something like a 5-year arm, we would ask certain questions like, okay, so how old are your kids, right? So my kids are 2 and 4. Well, that's great. So how much longer are they going to be in daycare? Right. And you would talk about things like that because, back there for us, daycare was, $1,000 a month, and I'm sure it's a lot more than that now. And
It's a mortgage payment.
Yeah,
If you have more than one.
and you work your way out of it. And we would say, okay, so tell me about your car situation, right? Now, what kind of car do you own? When's the payment going to be up? And then we could talk about a plan of what's going to happen in your life over the next, several years to fit you into a program that meets the payment.
Well,
right?
what kind of programs are we talking about?
Well, so there's going to be a couple different ones. So one of the first things I would talk about is what's called a 2-1 buy down, and they used to be popular. They're out right now. I'm not sure how long these will be popular for because of the
Right.
market we're in and going to be heading back into. But that's where the seller can give you a closing cost credit towards your mortgage. And so let's say the rate was 6% right now on the street, you get a 2-1 buy down. So your interest rate would start at 4% year one, year two would go to 5%. And then after that, it would go to a fixed payment of 6%. And what the seller is basically doing is prepaying that interest to the bank on your behalf.
Right.
Right. So, but the one I think is really that's going to come back are those ARMs. And
Yeah,
those,
that's where I thought you were going
yeah,
first.
yeah, and the 5-year and the 7-year ARMs are the ones. So, for instance, back in the day, let's say the interest rate was 6.5 on the street for a 30-year fix. You could get a 5-1 ARM probably around 5.25.
Right. It's a big difference.
It is. It was a huge difference, and that's where we'd sit down and say, okay, what's going to happen over the next 5 years? And we talk about economic cycles. Another chance to refinance, so forth and so on. One of the last strategies is, buy and refi. How many times did we refinance in our world? Right?
Sure. We were in a different rate environment.
Right. So you could say, all right, well, I can handle 6%, but I would like it to be lower. So we just keep an eye on the rates with you over the next couple of years. It hits 5.5. Well, your payment goes down $220. Well, you want to refinance, right? And then if it goes down from there, you just catch the cycles as they're coming to refinance down. But that's where I also think that the banks and the lenders are going to come out with some better products like that. Nothing like the fancy products that didn't make much sense back in 2005 and 6, but products that work for the people.
Sure. All right. And again, as you were consulting with the buyers, once a car payment drops, say in year 2 of a 5-year ARM, a car payment drops, they're paying $600 a month on that, and then that gives them that cushion that if the rates go up or that most people are afraid of locking into or are afraid of doing a 5 or 7-year ARM because they're afraid of that what if I'm in this ARM and I should have locked. But a lot of times, like you said, it's about that payment. And if you are in a point where you're in your earning years and you are expecting that you're going to earn more money, the kids are going to get out of daycare, you're going to lose that daycare payment. All of those things can factor into looking at the plan.
Exactly. And I just think that's the environment we're going back into, and where real estate professionals like ourselves who've been doing this for a long time are going to be able to sit down with our clients and have those, really good conversations about, okay, so I understand the rate is 5 7/8 right now. Well, let's figure it out.
Right.
And we sit down and we talk about it. We talk it through and we come up with a plan that works for everybody.
Absolutely.
It's really going to be a good place to be.
Right. It's great. I mean, obviously, you were a loan officer for much longer than I was, but I was in that field too. So having that background really helps us discuss these plans and these programs with our clients up front. But of course, then we have the great backing of our affiliates that we work with too. We've got 2 fantastic loan officers and companies that work with our clients, even as a backup. So we've got those resources available.
It's a team effort.
It is.
And we got a great team behind us.
We certainly do. So if you need any assistance and you want to talk to the Sable House team, we've got you can reach out to us the easiest way. Just hit us up on the web at the www.sablehouseteam.com. Nobody can spell it, but if you sound it out, you can figure it out.
Take a snapshot.
If you're watching us, yes, you can see it on our shirts, but right. If not, just phonetically sound it out or give us a call, and we appreciate you.
Sounds great. Thank you, Ms. Sabo.
All right, thank you.